All right, hello. This is Joe Novicus. We're going to look at financial analysis and some basic ratios talked about in Chapter 1. This file is from the wiki, the accounting wiki from the Accounting Pilot and Bridge project. So this information can be found there under Module 1. All right, so financial analysis. As students, we are studying what financial statements are, what goes on the balance sheet, what goes on the income statement. So now starts the process of analyzing these statements, and that's what financial analysis is looking at some basic metrics. And whenever we analyze a company, we always want to compare our metrics to prior periods, prior years, and then we also like to compare our ratios to the industry averages. Standard & Poor's publishes all the industry averages. You could only get those industry averages at your public libraries. You can't really find them in too many places on the internet because it costs a lot of money to put that stuff together, and these publications go for a couple $1,000s a pop, and the public libraries buy them, and that's kind of where you could go to look. All right, so let's take a look here. We have Faulkner Company, and we have the balance sheet. And so the first ratio we're going to look at is the quick ratio. The quick ratio is the best measure of liquidity. Liquidity means how quickly can you turn your assets into cash, and then the quick ratio really shows a firm's ability to pay off their current liabilities using the most liquid assets they have. So on the numerator, we have the three most liquid assets are cash, short-term investments, and your accounts receivables. And if we look on here, we only have two. We have cash and receivables. They don't have any short-term investments. So we add those two figures up, and then we're going to divide it by the current liabilities. Your current liabilities basically are due within the upcoming period, the upcoming year. So these are our current obligations. In this case, we have accounts payable, wages payable, and taxes payable. All three of those are going to be paid within the year, and which we'll eventually learn those are your current liabilities. All right, so when we do that, we're going to it's this plug and chug time. There's the 22,000 from cash, the 41 from accounts receivable, divided by the three current liabilities there. And then you have the metric comes out to 1.85. So what does that 1.85 mean? That means for every dollar in liabilities and current liabilities that we have $1.85 in cash, short-term investments, and receivables. So is that good or bad? Well, we always want to be over 1, of course. Okay, and then we want to look at the industry. So we want to look, is this ratio getting stronger, is it getting weaker, so forth and so on. So that's one indicator we want to look at. A more general one is the current ratio. The current ratio is just taking all your current assets, so that's the cash receivable. In this case, it's still and then inventories in there. I skipped out an inventory. Inventory is a current asset. So we take those three and we divide it by the current liabilities. So that's going to be the same number that we had before. So you can see now, once we expand, now remember, inventory is not considered the most quickly liquid, because when you have to sell off inventory, you have to go through liquidation sales. It takes some time. However, you could probably sell off a lot of that inventory within a year through a liquidation sale. So the current ratio is another liquidity measure that we want to look at when we're interpreting a financial statement. All right, the next one's the gross margin ratio. And in margins, you're always hearing in the news about companies talking about margins. Their margins are good, their margins are low, their margins are high, they're improving their margins. And remember, a margin is your sales minus your COGS gives you your margin. So we're going to take that margin, that gross margin amount, and we're going to divide that by sales, and that's going to give us our gross margin ratio. So what is our margin in relationship to our sales? So in this case, we have a margin of $152,000 divided by 400 in sales. We get 38%. So what that means is basically every dollar that we have in sales, we have a margin of 38 cents. Okay, and then that 38 cents is then going to cover all of our operating expenses below. All right, the next one is return on sales. So whenever I see the word return, I always think of the word net income. What is my net income in relation to sales? Return on sales, there it is, net income over sales. So when we plug and chug here, we have a net income of $27,500, and we divide that by the $400,000 in sales, we get a return on sales ratio of 6.88%. All right, so when we look at that, we have 6.88% ratio, and so that means for every dollar we have in sales, we have 6.8 cents in income. All right, the next metric we have is accounts receivable turnover. This is sales over our average accounts receivable. The reason why we use average accounts receivable is because our receivables are going to change throughout the year, and so we want to smooth out the process by taking the beginning number, which would be the 39,000, because when 2008 ends, remember this is the financial statement for at the end of 2008 is 39,000. And then that's going to be our beginning number. This is our ending number then for 2009. So beginning 2009, we start with 39. Ending, we start with 41,500. We divide those by 2 to get an average. And so then we take the sales amount and divide it by both. So in this case, we get 9.9379 times. So that means that we're basically, our receivables are turning over 9.9 times throughout the year. And to get a sense of how many days does it take us to collect, you take 365 divided by the turnover rate, and that comes out to 36.73 days. Inventory turnover is the last one we're going to look at here, and how quickly does a firm turn over inventory. When we look at stores like Walmart, I was down in Springfield, Illinois a couple months ago, and my son Mac was with me. And as we were walking through Walmart, you want to say hi, Mac, real quick? Say hi.
Hi, Mac.
Oh, you say hi, Dad.
Hi, Dad.
All right, Mac just walked in the room. When we look at Mac, we were in this Walmart, and this lady was taking she had a device in her hand. She was just waving it, and it was collecting inventory data from the shelves. Walmart does a really nice job of really turning over their inventory quickly so they convert it into capital and then reinvest it into further inventory. So they use technology probably the best than any other company on the planet at keeping track of inventory. All right. So when we look at this, we take the cost of sales. All right. The cost of sales is what is the cost of goods sold, and we divide that by the average inventory. So this is showing us the turnover rate, that basically we turn over that inventory 3.6 times. The reason why we're using COGS is because, remember, when we sell off inventory, it shows up as a cost of goods sold. We're selling off that inventory. And whatever we paid for that inventory, that's the COG amount. And then same thing what we did before, we're going to look at days. How quickly do we turn over the inventory? It's 365 days divided by the turnover. So this firm is turning over its inventory from the time they buy it to the time they sell it. It takes them, they hold on to that inventory for roughly 100 days. So with all these metrics, you're going to learn how to calculate them. The most important thing is the user. We were teaching you to be users of financial statements, and so we want you to interpret this data and tell us if it's good or bad based off of these figures. All right, so have some practice with this. Good luck, and email me if you have any questions.